Hi everyone, I'm Sean and this is Better Call Paul. I want to start out tonight by just saying what a wonderful time I had at the Blossom event on Sunday. Paul and I were there, met a bunch of people that were just fantastic. From the people that sorry, cat's here again. From the people that run Blossom to some other high contributors in Blossom, some YouTube people. It was a fantastic time. Got my Harvest shirt on that they gave away. I'm a big fan of Harvest. Uh, it was amazing. I suggest everybody try to get out there, and it's a great place to meet people, ask questions, meet some people that you follow, maybe. Just fantastic, amazing. Everybody should try to get to one of these events. But I want to talk tonight about best investment for passive income. Um, when it comes to passive income investing, the best option depends on your risk tolerance, time. How much time do you have to invest? A little bit of time. Are you older like me? Are you younger, your 20s and 30s? And how much effort you want to put into managing it. Here are some of the choices broken down a little bit for you. We have some low risk or stable passive income. You could get yourself a high interest savings account or a GIC. I believe in the States they call them CDs. They're safe, they're insured, they have very predictable returns. The downside, very low yields. They may not beat inflation. Uh, Government bonds or bond ETFs. Also reliable income for interest payments. They're safer than stocks, but they also have very low returns. If you're looking for something a little more moderate or risk passive income, you could get dividend paying stocks and ETFs. You could invest in some blue chip companies, banks, utilities, telecom, uh, things like that. They often pay steady dividends, and quite often they do have some increases every year in their dividends, which is fantastic if you like that kind of stuff. You could get some dividend ETFs, SCHD, or Canadian ETFs like VDY. They spread the risk out. Uh, they're very good payers, and you can't go wrong with them. You could do some covered call ETFs, which are very popular in Canada right now. It seems to be the new thing, the new kid on the block, maybe. Um, I could. Everybody knows there's a list of them. You could go over QYLD, ZWB, HDIV, HHLE, HHIS. One of my favorites. They generally generate high yields. They do it by selling options, covered call options. Uh, great income generator. They provide monthly cash flow through potential long-term growth is capped, but the monthly income is wonderful. And at my age, I'm 53. I'm looking for the monthly income. Um, some high risk or some higher potential, maybe. You could do real estate, direct ownership or REITs, uh, rental income if you own property directly, but requires the management unless you outsource it. It is a great revenue stream. Have somebody else pay off your mortgage for you. There is capital gains when you do go to sell, but it's often fantastic if you have the money for a down payment on a rental property and you can have somebody else pay off your mortgage and earn money for you. REITs are real estate investment trusts that let you earn property income without actually being a landlord. Or there's private lending, which is a peer-to-peer lending. You can earn interest by lending to individuals or businesses. Businesses, sometimes they can't meet their payroll, they need to borrow money, and you can actually get quite a high return from it. Um, like I said, there is high yields on them. You can make some great money, but there is the risk of defaults that people can't pay it back. You could have some hybrid long-term growth and income index funds with a maybe a dividend tilt, or a little bit more covered call ETFs in it with some really nice growth investment in it. As a rule of thumb, if you want steady monthly income, look at covered call ETFs, REITs, and dividend ETFs. If you want growth first, then income later, broad market index funds with a high dividend strategy are usually the best way to go. But you always need to diversify your portfolio so you're not relying on just one source if you're going to do the hybrid. Myself, I am a covered call ETF investor. I love the monthly income. I am older. I'm looking at about 7 years to retire. I'm lucky that I don't need the income of my dividends or my distributions at the moment. I just reinvest them every month, and it's for me that is my investment strategy. But everybody's a little different. I find if you're a little younger, maybe in your 20s or 30s, you can do a little more growth and a little less income investing. Maybe somebody in their 40s, late 40s, might want to do a little more income investing and a little less growth. And myself, being in my 50s, close to mid 50s, I just do covered call ETFs and reinvest it every month. I'm looking forward to maybe in the next year and a half, 2 years, hitting the $100,000 mark with my portfolio and really watch it accelerate. Okay, everybody, have a great night, and I appreciate everybody watching. This is just my journey and just how I see things. It's not financial advice. Everybody have a great night.